Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is August the 31st, 2023. It's now 4:03 p.m. Central Time. The bond market and the mortgage-backed security market are closed for the day after some big reports that came out today. You know, we've been talking so much about the employment numbers, the BLS numbers, and employment readings that we've not really paid attention to the fact that, guys, today was the release of the personal consumption expenditures reading, which is the Federal Reserve's favorite measure of inflation. That kind of went under the radar, and it still is flying under the radar a little bit. It's not even on the front page of CNBC right now. It used to be front and center whenever it would come out, because that is what we were looking to when we were trying to project what the Fed was going to do with the federal funds rate. Well, they have been so focused on talking about employment that we kind of are starting to let that just kind of drift under the radar. But let's take a quick look at what we're seeing here on the PCE. So let's jump over personal consumption expenditures reading here for July of 2023. The PCE came in at 0.2 on a month-over-month reading, which is very good. If every month the inflation reading on the personal consumption expenditures report for 12 months in a row came in at 0.2, that would mean that inflation is at 2.4% on a year-over-year reading, which is almost exactly what the Fed wants. So getting a 0.2 reading on the headline number is very good. Now, on the core reading, which excludes food and energy, which is this number here, and the Federal Reserve tends to pay more attention to that number because it is less volatile. It doesn't include food and energy, which does move quite a bit. Now, we always kind of like to joke a little bit because I don't know about you, but I have to pay for food and energy no matter what. So it seems like, why would it ever exclude food and energy? But that's what they like to do. So what number is that? Again, for the month of July 2023, it came in month over month at a 0.2 inflation reading, which is a good, calm number for us. And also, take a look at the core reading here on a month over month for the last few months: March, April, May, June, July. Let me make that clear: 0.3, 0.3, 0.3, 0.2, 0.2. So we see that slowly subsiding and coming down. Now, here's what you need to understand. A lot of people are not happy, and they're talking about inflation went up with this new personal consumption expenditures reading that came out. The reason is because on a year-over-year reading, it's going to show inflation ticked up a tenth from last month. Okay, so they're seeing it as a bump higher, even though we're seeing a very nice, calm, steady month-over-month reading. And the reason is because if you watch this show and you were to go back far enough, you might remember that the July reading of the PCE, the personal consumption expenditures for 2022, was an anomaly. It was exceptionally low. It came in while inflation was pretty high all around. For that month, inflation came in on the personal consumption expenditure at negative 0.1. So there was an anomaly low month that we knew this was coming. We knew this month was coming for a while, and we thought it might be a little bit painful because we were going to be losing this anomaly reading of negative 0.1, and replacing it with anything other than that is going to cause us to bump up a tenth or 2/10 or 3/10. Well, fortunately, it bumped up a tenth. Okay, so it wasn't as big of an adjustment as it could have been. But again, the media wants to say inflation is on the rise again, when we really have to look a little bit more closely at that and see that that anomaly month dropped off. We're on a more normal reading at this point, and we continue to see inflation slowly coming down. So I want to make sure you understand. However, how are the markets responding? Well, first of all, let's go over here and look at our charts. We're up 9 basis points on the mortgage-backed security, which is really good to see. We're up on a day that there's a lot of people in the media saying that we had a bump higher in personal consumption expenditures inflation. All right, so that tells us that the market is being smart enough to look further into it, and we're seeing a really subdued number, actually a little bit of an improvement here on our mortgage-backed security. The 10-year Treasury is following suit. It's down 1 basis point, really sitting here about 410. We've been at 410, 411, 4.09 most of the day. It wants to sit right about 410 right now, which we've talked about many times, that 410 is a psychological reading for the 10-year Treasury. There's just something about 410, 420, and really 4.0. We want to get down below 4.0, but it's good to see us moving in the right direction. Let's take a look at our chart here. You can see this ceiling of resistance over here, this Fibonacci level, which is 98.716, really kind of acting as a true ceiling of resistance, and hopefully now a floor of support if we can close today just above it. And you can see when we started to flirt with banging up against this 50-day moving average, which we quickly retraced and went back the other direction. 10-year Treasury right quick here. We're going to take a look at where home loan interest rates are today in just a moment. But the 10-year, let's take a quick look at this. Again, here we are now a little bit in a range. We can move up and down a little bit, but we want to see this go below that 410 and start fighting with the 4.0 number because we need to see the 10-year Treasury come down. Where are we on our home loan interest rates? Let's run our Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan here. Again, these are mortgage broker rates that are available through Rancho Capital, not through these individual banks. Let's open this up. All right, very well qualified 30-year fixed conventional home loan, 7.25% with a credit of $511 through the loan store. Let's take a little bit further down. 11 mortgage, 7.25% with a cost of $400. Flagstar, PRMG, United Wholesale is 7.25% with a cost of $1,269. Now, let's open this up here, take a little bit of a deeper dive. What if we were to pay a point? Here we go, just about a point. It's 6.75%, and our favorite number that we like to take a look at is 6.0, or we want to try to get into that 5.99 number. 3.4, guys, that is a lot better than the 5.4 that we were seeing just the other day, right? You guys recall that. So let's close this up, take a look at United Wholesale. We always take a look at United Wholesale since they are the largest mortgage lender in the United States of America right now. And where are we at? If you were to pay a point, you're at 6.875, very similar. And if you wanted to get to that 5.99, 3.143. So you can see, once again, if you want to get down to that 5.999, the easiest way to get there is through United Wholesale because they're just a little bit more effective on these large buy downs. And we're hoping that we're going to start to see the 6.99 number very soon. Right now, 6.99 is costing a little bit over half. Hopefully, we're going to see that 6.99 number coming with no points the next time that we take a look. Quickly, take a look at the parameters, and I'll tell you what we have to watch out for tomorrow. Okay, so here we are. These are the parameters for the Brent Bruce Daily. We always take a look at that for the compliance purposes. All right, so tomorrow, what are we looking for? First of all, we're going to start to see a little bit more about how this is digested, the personal consumption expenditures report, and how it gets digested overnight as investors go through this in a little bit greater detail. And also, again, all eyes are on the Bureau of Labor Statistics report that's coming out tomorrow, the employment numbers. Now, when you turn on the news tomorrow and you hear that the employment numbers came out, the word you don't want to hear is hotter. We don't want to hear hotter than expected. We do want to hear maybe under expectations, cooler than expected. And the number they're kind of looking at right now, we're hearing, is 185,000. So if they see job creations at over 185,000, they're going to say that that's a hot report. Under 185,000 or anywhere near that is going to be either a calm or subdued or cool report. Now, it's hard to say this. It's hard to feel this sentiment, but we need to see employment hurting. Okay, so we need to see less hiring, more firing. All right, and again, it's hard to say, but that is the way that the Fed looks at employment. So they're saying, look, if you're out there hiring, if you run a restaurant and you're hiring, then things are good. People are spending money. That causes inflation. The demand is high. And that happens for every retail establishment and everywhere else. The first thing you do as things cool down, number one, is you stop hiring, right? So you slow down. If you were going to hire 10 people, now you're going to hire 5. If you were going to hire 5, now you're going to hire 1. If you were going to hire 2, maybe you're not going to hire anybody. So the first thing they want to see is they want to see a slowing of hiring. And then if it goes a little too far and it moves a little bit further over, they may even be happy to see some firings, some layoffs, because they want to see the economy cooling. And once again, if everyone's pulling back, the economy is cooling, people aren't spending money on extra things, less clothes, right? Less vehicles, then that's going to cool down, the hirings slow down, and maybe even the layoffs kick in. And that is unfortunately what the Fed wants to see, because that would be a result of their pressure that they have put on the economy. You remember, Jerome Powell said he wanted to create pain in the economy to cool and slow the inflation that we were experiencing. So while we're seeing inflation subsiding on many of the reports, the PCE, the CPI, the PPI, and all of those, they're not liking the way that the employment readings have been coming out too hot. Now, once again, do we believe these employment readings? There's been lots of reason maybe to question it, whether there's validity to it or whether they've made some changes to the way that they calculate those numbers, which are inflating the employment numbers. But at this point, I think we're going to start to see a little bit of a change. So we will see tomorrow. 185 is a number. 185,000 is a number that is going to be the line in the sand to whether it's hot or cool. Make sure to watch out for that. You'll hear again from me tomorrow. Make sure that you like, subscribe, share, and hit that notification bell at the bottom. Make sure you let everybody know about this show here so they can also follow along. We'll talk to you again tomorrow.